It's time now for Charting Futures. Here's Abigail Doolittle. And Abigail, another day and more record highs for stocks. What are the charts suggesting?
Well, Romaine, we're going to take a look at those charts, and we're actually going to take a look at one that had looked pretty good but turned out to be wrong, or maybe it won't be in 2020. It's going to be interesting to see that for sure. Here we have those record highs, though, for the S&P 500 E-minis up 0.7%, the NASDAQ 100 E-minis. Interestingly, though, the Russell 2000 still not near a record high, so that could be one thing to be concerned about unless it continues to gain above a key level that many have been watching, 1600, but confirming the risk-on tone. Take a look at the 10-year bond futures down. So it is certainly a risk-on day. Stocks higher, record highs on trade optimism, plus the whole year of 2019 climbing that wall of worry. And here is that wall of worry. This is a chart that we've looked at in the past that suggested we could see a big bearish break to the downside. That's not really happening, though, as we know. So take a look at this range between roughly 2,400 and 3,000. This is called a bearish broadening formation. It suggests that there's wild uncertainty, which has been the case for much of this year, but the Fed's been behind investors' back. That's a big piece probably of why we're seeing this breakout to the upside. The last pattern within it, though, is breaking to the upside. There's a specific target, 3,200. The question whether or not stock investors will keep those gains or if we'll go back down into this pattern that is traditionally bearish. To talk more about this range and another range, Greg Calderone of Bloomberg News, thank you for joining us. And so what do you think about that chart? Because there, months ago, weeks ago, I certainly showed it many, many times because it was very powerful, lots of bearish patterns in there, but that has not been the case. Buyers have just taken over and we're seeing this move up. Do you think it could be a false initial reaction, then we go back down into that bigger range?
Not necessarily. Going back to that larger range we talked about, market was largely range bound from, call it, March until the end of October.
Okay, and we have your chart showing that smaller range within the bigger range.
Yeah, and over the past couple of months on the same segment here, we've actually talked about that potential breakout. So right here you have, starting in March, we kind of recovered the Q4 loss of 2018, if you will, pretty quickly in the first 2 months of the year. And then the S&P was largely range-bound, call it up and down about 3.5% for a good portion of the year. And then we started to bump into that resistance, some decent earnings, so on and so forth, some decent news out of the trade situation between the U.S. and China. And then all of a sudden we kind of had the breakout towards the end of October.
Okay, so pattern-wise, 3,200. Let's take a look at how you would suggest or some observations that you have around options trading on the S&P 500 E-mini futures, because certainly bullish for December, but maybe we are seeing some hedging activity for March.
Yeah, so you've seen that ratio of calls to puts kind of be weighted to the put side over the next couple of quarters. S&P E-mini puts actually, or options, actually only expire quarterly. Mm-hmm. So right now we're in December. That'll expire this month. You're seeing a fair amount of open interest outweighed to the puts versus the calls, even though the market's kind of ripping higher. What we kind of think we've seen here is people selling puts to finance call buying. And it's a similar situation for March. But if people want to go out and another couple of months and look to hedge some of these astronomical gains, if you will, they can actually go out and potentially buy put, sell call, which is kind of the inverse of what we've seen in the market.